In this example, we're going to look at the difference between revenue and capital expenditures. Revenue expenditures are ordinary repairs that get charged to a repairs or a maintenance expense and then end up on our income statement as expenses that go against revenues. They're just regular things that are required throughout the life of property, plant, and equipment to keep it useful. Capital expenditures, however, make huge differences in either the useful life or the productivity of the equipment. If there is an expense that has that qualification, then it gets capitalized, which means that instead of being recorded as an expense, it is added to the original cost of the equipment. So we have three different examples. The first one is, what is the journal entry to record that we paid $22,000 cash for a new component that increased our piece of equipment's productivity? Well, that is a capital expenditure because it increased the equipment's productivity. So to record a capital expenditure, we would debit our equipment account and credit our cash account for the amount. Number two is that we paid $6,250 for repairs and maintenance. Well, we know any repairs and maintenance just becomes an expense of the period unless it increased the useful life of the equipment or added to its productivity. So this is just a repair expense. And we paid cash. The last one is that we paid $14,870 for significant repairs to increase the useful life of the equipment from 4 to 7 years. So this is a capital expenditure because we increased the useful life by 3 years. So we would record equipment and cash, a debit of $14,870 to equipment and a credit of $14,870 to cash. Now let's look at this, that we increase the useful life of the equipment. So we need to redo our depreciation expense because now instead of a 4-year useful life, it has a 7-year useful life. So let's imagine that we made this change during year 2. So we have our equipment account and our accumulated depreciation equipment. So we would have recorded the $264,000 cost of the equipment and now this capital expenditure that increased the useful life. We're at the end of year 2, so we would also have 2 years of accumulated depreciation. So our yearly depreciation using straight line, 264,000 minus 29,000 divided by 4. So we would have 2 years of depreciation of $58,750. So now to make changes to the useful life, we've decided that instead of 4 years, this is going to be useful for 7 years now, but we've already depreciated for 2 years. So we use the book value to determine what our new depreciation expense is for year 3. So now we have a book value on this asset. We purchased it for $264,000 and we added expenditures of $14,870. And we have 2 years of depreciation. So we have a book value of $161,370. So now our new depreciation expense is our book value, so $161,370 minus our salvage value of $29,000, and it's divided by 5. And the reason it's divided by 5 and not 7 is because we have a 7-year total useful life and we've already depreciated 2 years. So that means we have 5 years left of its useful life. So our new yearly depreciation expense would be $26,474. Now let's look at an asset disposal. So we have a machine that has a cost of $250,000 with accumulated depreciation of $182,000. We're going to prepare journal entries in each one of these different situations. So the first thing that we want to do when we're looking at machine disposal is determine what its book value is. So our book value is cost minus accumulated depreciation, $250,000 minus $182,000. So this machine has a current book value of $68,000. Every time that we dispose of or sell a piece of property, plant, or equipment, we need to remove that property, plant, and equipment from our records by crediting the account where it's stored, and we need to remove the accumulated depreciation. Because accumulated depreciation has a credit balance, we need to debit accumulated depreciation. So we would have accumulated depreciation equipment and then our equipment account. We need to remove the $182,000 of depreciation or accumulated depreciation and the $250,000 historic cost of the equipment. We need one more debit to balance our equation of this $68,000 difference. Because we received nothing at its disposal, this is a loss of $68,000. So we would record a loss on disposal. If we sold the machine for cash, we would have a very similar transaction, except we would also include that we received cash of $35,000. So now our loss is $33,000 because we received some cash to make that payment. Now, if we sold the machine for $68,000 cash, we would record the cash, $68,000. We would have our accumulated depreciation of equipment, and we would remove our equipment. So there would be no gain or loss with this transaction. Okay, and if we sold the machine for $80,000 cash, we now have $80,000 in cash. We've removed our equipment and its accumulated depreciation from the books, except in this circumstance, we have a gain on disposal. And we need to record a gain of $12,000. Now let's look at what happens if we exchange it for another asset instead of disposing of or selling of it. So we have a tractor and we're trading that tractor in for a new one, and we're receiving a trade-in allowance and we're repaying the remaining $83,000 in cash. We have our historic cost of the tractor and its accumulated depreciation. We have a list of questions. First, what is the book value of the tractor? Well, that is its historic cost minus its accumulated depreciation. So 96,000 minus 52,500. So the book value is $43,500. The next two questions are easier to answer if we have a journal entry. So things that happen in this journal entry. 1, we receive a new piece of equipment. So we're going to debit a tractor account to put that tractor on the books. We also need to remove the accumulated depreciation of the old tractor. And we need to remove the old tractor from our records. And we paid some cash out. So we have accumulated depreciation on the tractor of $52,500. We had historic cost of $96,000, and we paid cash out of $83,000. So now we need to calculate what is the value of the new tractor and whether or not we had a gain or a loss on this transaction. So I'm going to assume that we had a loss because it didn't ask us if we had a loss or a gain. So loss on sale. So first, what amount should be recorded in the asset account for the new tractor? So what is the value of the new tractor? Well, what did we give to get it? That's what the value is for our records. We paid cash of $83,000. We also received a value of $29,000 for our old asset. So $29,000 trade-in allowance. So the value of our new tractor is $112,000. Now we need to know our loss. Well, what is the loss on that? Well, it's the difference between our book value and what we were given for our trade-in allowance. So our book value minus the $29,000 trade-in allowance. So our loss was $14,500. Our last example is looking at two different types of long-term assets. The first long-term asset that we're going to look at is a natural resource. For natural resources, we deplete them instead of depreciation. So it's called a depletion expense. The way we calculate depletion is similar to the units of production for depreciation expense. So we determine how much of a natural resource we believe we're going to get out of that asset, and we use that as our units of production. So we have a mine, and it tells us that it has 0 salvage value, and we believe it's going to contain 1,525,000 tons of ore. So first, we're going to figure out what our depletion is. So it's our historical cost, 3,721,000, minus salvage value, which is 0, divided by the number of units we believe we're going to receive from it. So the number of tons that it contains. So we have a depletion rate of $2.44 per ton. We also have a piece of machinery there. So we have our machine depreciation. So on the machine, they want us to use the same method as the mine's depletion. So we would use units of production. So we're going to take our historic cost of our machine, $213,500, minus salvage, which is 0, and divided by the number of tons we believe we can get out of the mine. We then have a rate of 14 cents per ton. Now we need journal entries to record year-end depletion and year-end depreciation. So we would have depletion expense and accumulated depreciation for the mine. And then we have depreciation expense and accumulated depreciation equipment. This is accumulated depletion. Okay, so for the depletion, we take the number of tons of ore that we removed from the mine times our $2.44 per ton. So 166,200 times the $2.44. For our depreciation expense, we take the number of tons, 166,200 times our rate of 14 cents per ton. Our last example looks at copyright. So we have an art gallery that has purchased the copyright on a painting that is still good for 10 more years. After those 10 years, the copyright expires, which means that the painting becomes public domain and anyone can make copies of it. So we paid $418,000 for that copyright. First, we want to record the January 1st receipt of the copyright. So we received a copyright and paid cash. We paid $418,000. Then on December 31st, we're going to amortize this copyright. So we have amortization expense and accumulated amortization copyright. Our amortization expense is the cost divided by our useful life. There's no salvage value for a copyright, so 418,000 divided by 10 years useful life.